Good morning and welcome to today's 5 with Fitz. I'm, of course, Keith Fitz-Gerald. Thank you, as always, for joining me. You know, it's Friday, but looking at the early market action, you'd never know it, right? Stocks, stonks, have sold off hard, as you know. AI spending fears roil the chip makers, or so the story goes. Hi, hi. We've seen this more times than we can count, folks, and we've talked about it even more still. Markets reset periodically for a variety of reasons. This morning, it's a combination of several factors: reaccelerating war in Iran, oil prices, and rising yields, all of which means that the cost of leverage has gone up. Traders need to reprice risk, and with it, the need to sell shares and anything higher than normal, like, I don't know, chip stocks. I mean, really? Here's the numbers behind what I'm saying, just in case you don't believe me. The 10-year note touched 4.62% earlier this week and is still holding stubbornly somewhere in the 4.60 range, which is the bond market's way of pricing in a war that refuses to end. Meanwhile, at the same time, WTI sitting around $79 a barrel, up more than 11% on the week, with Brent closing in, I think it's about $84 on Thursday, yesterday, if my memory's right. And as for chip stocks, well, they're always first on sale when the cost of leverage rises because they've got less room for error and even less room to absorb multiple compression, right? In other words, situation normal. So run for the hills if you want, but know that the markets are the only store on earth where customers fear a sale. That's important. Let that sink in, because the underlying case for owning the world's best stocks is actually getting a lot stronger in many cases, particularly if they continue to put up good numbers. We're about to find out. Now, once upon a time, sell-offs like this were driven largely by fundamentals. But these days, not so much. In fact, my research suggests that roughly 84% of daily volatility is now driven by market structure, not stocks themselves, not even headlines related to stocks. There's an image in the written version that I really want you to burn in your brain. And think about that for a moment when you do. There's also a 98% correlation between earnings and price over time, which means that if earnings remain strong, well, guess what? Follows over time. Yeah, exactly. Price tends to follow over time. So when you got a sale on your hands like we do today because others don't understand the relationship that I've just shared with you, well, guess what history also clearly suggests you should be doing? Bingo. Yep, again. Buying, right? Even if you have to think defensively about doing it. Not blindly, mind you, but buying the world's best companies, particularly those making must-have products and services that the world can't live without. Contrary to what many believe, it's actually a pretty short, sharp list. Anyway, enough of that. The slide I've just shared with you in the written version and what I've just told you about is from one of the presentations I'll be delivering tomorrow at what we call Shindig 26, our annual conference for the One Bar Ahead family. And I've got to get on the road later this morning to meet up with everyone who is coming from around the world to attend. Now, if you're going to be one of them, other topics include what my latest research says about volatility, market structure, and which stocks could benefit most. That's one of the things. I'm also going to be talking about optimizing entries and exits using proprietary OBA indicators. We're going to be talking about required minimum distributions, RMDs, how to read an annual report in less than 10 minutes without wanting to set it on fire and having your eyeballs glaze over. We're going to be talking about the biggest risk, no matter what your age or investing stage, and how to overcome it, and all sorts of things like that. Anyway, it's always a great time, and as usual, I'm super excited to see everyone, including you, if you're on your way to. And if not, next time. Meanwhile, and before I head out the door, a couple things I want to talk about. Netflix reported roughly inline Q2 results, EPS slightly beat, revenue slightly missed, but the stock's fallen hard as investors were disappointed by the forward guidance and reduced engagement reporting. Transparency. Now, I said on Monday that I'd potentially be interested in a dip, but the fact that the company plans to reduce visibility into user metrics nixes that idea. So Not happening. Apple continues to hit new all-time highs. Funny how that works after the naysayers have been writing them off and insisted that the company was done for. Not to mention called me all kinds of things for saying it wasn't. Anyway, PayPal is reportedly rejecting Stripe and Advent's offer as inadequate. Like that's a surprise. SpaceX has now fallen further below its IPO prices, off 40% highs, just as I suggested would happen back in the past. See number 5 if you're reading along. I've repeatedly warned investors to steer clear of publicly traded fast food stocks. And while my original concern was margin erosion, the discount wars, this week is a reminder that there's more than one way the sector can bite you, pun absolutely intended. Taco Bell is now pulling lettuce and other ingredients nationwide after a multi-state cyclospora outbreak was traced to one of its suppliers. All right. Oil prices have risen on escalated U.S.-Iran tensions overnight again. And the yeah, but crowd is, of course, having a field day because they've told you this was coming. Well, true. Many are so good and so consistent that they've called 22.5 out of the last 2 actual corrections, sell-offs, pullbacks, whatever it is you want to call them, right? The thing is, investing in optimism beats cowering in fear, especially on days like today. Since 1871, let this sink in, there have been 151 rolling 5-year periods, 87% of which have been profitable. There have been 146 rolling 10-year periods, 96% of which have been profitable. And there have been 136 rolling 20-year periods, 100% of which have been profitable. So, once again, at the risk of sounding like a broken record, the cost of missing opportunity is always more expensive than trying to avoid risks you can't control. Today's bottom line relates very carefully to that. Uncertainty always paves the path to profits that others can't imagine. So, now and as always, let's make it a great day and finish the week strong. You got this. Thank you as always for watching, and I will see you on Monday. Make it a great weekend. Cheers.